Have you ever wondered which is better, value investing or growth investing? It's one of the oldest debates in the world of investing. And in 2025, that debate is more relevant than ever. Because the rules have changed. Technology is evolving. Markets are shifting. And investors are asking which strategy truly wins in this new era. To answer that, let's start with the basics. Value investing and growth investing are two completely different mindsets. Two ways of looking at the same stock, but through very different lenses. Value investors look for bargains. They believe that the market sometimes overreacts, that good companies can become undervalued because of fear, bad news, or temporary problems. They hunt for deals. They look at financial statements, price-to-earnings ratios, and balance sheets. They're like treasure hunters searching for hidden gems buried under market noise. The philosophy goes back to legends like Benjamin Graham and Warren Buffett. Their core belief? Buy a dollar's worth of value for 50 cents. Now, on the other hand, growth investors chase potential. They don't care much about the current price. They care about the future. They want companies that are growing fast, disrupting industries, and changing the world. Think Tesla. Think Amazon. Think NVIDIA. Growth investors believe that innovation and momentum can drive massive returns even if the stock looks expensive today. In other words, value investors buy what is cheap. Growth investors buy what is becoming big. Both have their pros and cons. Both can make you money. But in 2025, the lines between them are getting blurrier than ever. Let's talk about why. For decades, value investing ruled the markets. Buffett's philosophy, be fearful when others are greedy and greedy when others are fearful, worked beautifully in the 80s, 90s, and even early 2000s. Investors could find strong companies trading below their true worth. The economy moved slower. Information traveled slower. And patience was rewarded. But then came the rise of technology. The internet. Cloud computing. Social media. And artificial intelligence. Suddenly, growth stocks started dominating. Tech companies weren't just making products, they were changing how people lived, worked, and connected. Between 2010 and 2021, growth investing crushed value investing. Companies like Apple, Google, and Microsoft became trillion-dollar giants. Their stock prices soared while traditional value plays like oil, banks, and retail lagged behind. Investors began to believe that value investing was dead. But then 2022 happened. Inflation surged. Interest rates spiked. And suddenly, expensive growth stocks took a beating. Investors realized something important. Growth is powerful, but valuation still matters. So in 2025, the conversation has shifted. It's not about picking one side, value or growth. It's about understanding when each works best. Let's break that down. Value investing tends to shine during periods of high interest rates and economic uncertainty. That's because value stocks are usually more stable, profitable, and less dependent on future promises. For example, companies like Johnson & Johnson, Coca-Cola, or Procter & Gamble, they may not grow fast, but they make consistent profits, pay dividends, and have strong balance sheets. When markets get volatile, investors look for safety, and that's where value shines. But when interest rates are low, innovation is booming, and the economy is expanding, growth stocks take the lead. That's when companies like NVIDIA, Meta, and Amazon explode in value, driven by future potential. The trick is knowing where we are in the cycle. So, what does that mean for 2025? Well, we are in a very unique situation. Inflation has started cooling, interest rates are still high but stabilizing, and the AI revolution is transforming every industry. That creates both opportunities and traps for both value and growth investors. On one hand, value stocks might look boring, but many are trading at huge discounts because all the attention is on tech. Sectors like energy, healthcare, and finance are quietly regaining strength. On the other hand, growth investing is still alive and kicking, especially in AI, green tech, and robotics. The difference is that you can't just buy anything with AI in its name and expect it to 10 times anymore. In 2025, growth investing requires more discipline. You have to separate hype from substance. Ask, does this company have real revenue, real innovation, and real scalability? Let's look at a few examples. Take NVIDIA, the poster child of growth investing in the AI era. It's grown massively, dominating the GPU market. But with such a high valuation, new investors must ask, am I paying for growth that's already happened? Compare that with something like Intel or AMD, slower growers, but with solid fundamentals and lower valuations. Those could be value opportunities hiding in plain sight. Or consider electric vehicles. In 2021, Tesla was the face of growth. But in 2025, competition from BYD, Rivian, and legacy automakers has changed the landscape. Growth investors now have to be selective, focusing on companies that can sustain profitability, not just hype. Meanwhile, value investors might be eyeing sectors that were left behind like utilities, infrastructure, or consumer staples, companies with strong dividends and stable earnings that the market has ignored. Here's what's fascinating. Some of the best investors today are blending both styles. They're what we call GARP investors, growth at a reasonable price. They look for companies that are growing, but not so overvalued that the risk outweighs the reward. In other words, they want the best of both worlds, growth potential with value discipline. This hybrid strategy fits perfectly in 2025's market, where AI-driven disruption and cautious economic sentiment coexist. Now, let's talk about psychology because mindset plays a massive role in both strategies. Value investors need patience. Their approach can be slow and often frustrating. They buy when others are fearful, and it can take months or years for the market to recognize a stock's true worth. Growth investors, on the other hand, need conviction. They buy into big visions sometimes before profits even exist. They believe in the future, in innovation, and in scalability. Both mindsets require emotional strength. Value investors fight fear. Growth investors fight greed. Now, how can you decide which one suits you? Start with your personality and time horizon. If you like numbers, analysis, and patience, you might lean toward value investing. If you're excited by innovation, technology, and long-term disruption, you might prefer growth investing. But here's the truth, you don't have to choose just one. In fact, a smart portfolio usually includes both. Think of it like a balanced diet. Value stocks provide stability and income, the vegetables that keep you healthy. Growth stocks provide excitement and potential, the protein that builds muscle. A good portfolio needs both to thrive. So, how do you balance them in 2025? One approach is the core satellite method. You make value stocks your core, stable, dividend-paying companies that provide consistency. Then you add a few high-quality growth stocks as satellites to capture big opportunities when innovation booms. That way you are not gambling on one style. You're adapting to the market, not fighting it. You could also use ETFs to make this easier. For example, you can invest in a value exchange traded fund, like the Vanguard Value Exchange Traded Fund, and a growth exchange traded fund, like the Vanguard Growth Exchange Traded Fund. Together, they give you diversified exposure to both sides of the market. But remember, it's not just what you buy, it's when and how you buy. Timing matters. If you chase trends blindly, you will overpay. If you ignore trends completely, you will miss opportunities. The secret is balance. Now, let's look at what experts are saying about 2025. Many analysts predict that value investing might have a comeback. That's because high interest rates tend to hurt growth stocks more, especially those with little or no profits. At the same time, many value sectors are still undervalued relative to history. Energy, manufacturing, and healthcare could outperform as global demand stabilizes. But don't count growth out yet. AI, automation, and biotech are still driving the next wave of innovation. There's still massive upside if you choose wisely. So instead of asking value or growth, ask yourself, where is the smart money flowing now? Look at fundamentals. Look at trends. And most importantly, look at valuations. Because whether it is a value stock or a growth stock, the price you pay determines your future returns. Warren Buffett said it best, price is what you pay. Value is what you get. That applies to both strategies. Let's recap what we've learned. Value investing is about buying solid companies for less than they are worth. It's grounded, disciplined, and focused on fundamentals. Growth investing is about backing innovation early. It's visionary, high risk, and high reward. In 2025, both can win, but the winners will be investors who adapt, diversify, and think long-term. So don't be a value or growth investor. Be a smart investor. Learn from both sides. Build a portfolio that can weather storms and ride waves. Because markets will change, trends will come and go, but disciplined investing that never goes out of style. So the next time someone asks, "Are you a value investor or a growth investor?" you can smile and say, "I'm both." Because in 2025, the smartest investors aren't choosing sides. They're building strategies that evolve with the times. And that's how you win, not just this year, but for decades to come.